Continuing our coverage of the For the 99.5% Act, there will be changes potentially to Grantor Retained Annuity Trusts, or GRATs. Code Section 2702, which is a gift tax evaluation section, might be changed to 1. Impose minimum and maximum terms on GRATs. The minimum term will be 10 years, and the maximum term will be the grantor's life expectancy plus 10 years. There will also be a minimum remainder interest value of the greater of $500,000 or 25% of the upfront value of the trust. Note that these changes are isolated to Code Section 2702, which is a gift tax valuation section. No changes will occur to Code Section 2036, which determines the value of a GRAT if the grantor dies during the term of that GRAT. So there will be no change to the estate tax valuation of a GRAT. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode 174 of 10 Minutes with Griffin, is entitled For the 99.5% Act Part 3, Kiss Your GRATs Goodbye. So we're going to look at some of the changes on GRATs. I want to note that there's a lot of rabbit holes we can go down here, especially with the numbers behind the effect of this change. We just don't have the time to dive into all those changes today, so really our focus is going to be on the substance of what those changes are and a broad view of how this might affect GRATs and whether the GRAT going forward might still be an effective leveraging strategy for saving transfer taxes through the time value of money. As always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you would like a copy of these slides, please email me at griffin.bridgers@gmail.com. So what's changing? Bernie Sanders, as I've mentioned in the previous episodes, has introduced the For the 99.5% Act, which will enact sweeping changes to estate, gift, and generation skip and transfer tax laws. But even if this is not enacted, it shows for the first time a shifting from general policy documents to an actual Senate bill in terms of what might be coming down the pike in terms of tax reform. Now, I note that GRAT reform has been on the list for well over a decade, dating back to at least the Obama administration. This is really the first time we've seen this proposed as a meaningful change to GRATs. A number of other people have proposed it, but really in contexts where it wouldn't have really gone very far at all. Now, what this does is it changes some of the valuation plays you can get within a GRAT. Now, in case you're not familiar with GRATs, this is an irrevocable trust that you can really split into two valuation components for gift taxes and sometimes for estate tax purposes. You can split this into a present interest annuity component, which is retained by the grantor and is not subject to gift tax, and a remainder interest component, which is gifted away. Now, it used to be that all you had to do was create an annuity interest and you get this gift tax valuation play, because the annuity interest is something that's retained by the grantor and thus is not subject to gift tax. And as the trade-off, there's a play here where you typically assign a term of years to the duration of the trust, because what you want to have happen is that the grantor outlives the term of the trust so that you remove those assets from the gross estate. Now, if the grantor does not outlive the trust term, the value of the GRAT at death could be included in the gross estate, but you might also get another bite at the apple, another valuation play there, where if the 75/20 rate goes up prior to death, you can get a lower value on the amount included in the gross estate equal to the annual annuity divided by the 75/20 rate that's in effect at the date of death. So that bite at the apple is not going away. Instead, it's the upfront bite at the apple for gift tax purposes that might change. Because, as I mentioned, Code Section 2702, which is a gift tax valuation component, will impose certain changes, and without those changes, if you fail them, what's going to happen is that the grantor is going to have a value of 0 assigned to their retained interest. So instead, for gift tax purposes, the entire gift will be treated as a gift of the remainder interest and will be subject to gift tax up front. So what are those changes? One, there will be a minimum term of 10 years on the GRAT. Now there's some other minimum value thresholds that really tie into this short-term GRAT concept, which we'll discuss in a minute. Now, currently, this may be abusive, it may not be, depending on how you look at it, but GRATs can have a pretty short term. Typically 2 years has become the norm. And with that shorter term, it allows you to zero out the value of the GRAT, meaning that using IRS actuarial tables, the present value of the remainder interest, which is the component that's subject to gift tax, can be 0. So this results in no gift tax at funding. So the end result is that you remove stock with high growth potential from your gross estate. Then when you die, obviously you have the annuity that's come back to you, but you also reduce the chance that you fail to outlive the trust term. So it's an easy way to remove the appreciation in the value of the trust over and above the 75/20 rate from your gross estate with no gift tax cost. That could go away with this minimum term of 10 years, but you also remove the ability to use a lot of long-term GRATs. Because with the long-term GRAT, right now you could do something like a 99-year GRAT. There's a lot of options out there that have been bandied about by practitioners. And obviously, it's virtually a guarantee with a long-term GRAT that you're going to die during the trust term. And Code Section 2036 would cause the assets to be included in your gross estate within that GRAT based on date of death fair market value. But there is a carve-out for GRATs under Code Section 2036, which allows you to use a lesser value where if the 75/20 rate goes up, you can divide the annuity by that 75/20 rate in effect at your death, and that might result in a lesser value of the GRAT included in your gross estate, which is another estate tax play. Now, the Act is going to remove some of that hedge that you get on the back end by imposing a maximum term on GRATs equal to the grantor's life expectancy plus 10 years. So for example, somebody who's 60 years old could not create a 99-year GRAT. Now, this comes into play more with a short-term GRAT than a long-term GRAT, but there's a minimum upfront value threshold because remember, when you play with this, you could get a 0 or close to 0 value for the remainder interest that's actually being gifted to remainder interest beneficiaries of the GRAT. In other words, who gets the GRAT assets at the end of the term? Because only that present value of remainder interest is subject to gift tax. So what this Act proposes to do is strip out the ability to do a zeroed out GRAT, so there will be a minimum value threshold equal to the greater of 25% of the initial fair market value of the GRAT, or $500,000. Now, I want to remind you again of the context of these changes because the change is to Code Section 2702, which is only a gift tax valuation provision. So all it does is remove your ability to subtract the present value of your retained interest for gift tax purposes. So what we might see is more of a play where you look at trying to create as low of a gift tax value for your retained interest, but also maybe get more than that back economically. I'll explain that in a later episode as to how that could happen. But what this doesn't change is the back-end treatment of the GRAT under Code Section 2036. So you could still get some of the estate tax valuation plays that are inherent in certain GRATs, especially long-term GRATs. And you still get the benefit, too, of a higher exclusion if, say, you fund a long-term GRAT now and the exclusion goes down, because you have that anti-clawback provision under Code Sections 2001B2 and 2001G. So the big question here is, are grantor trusts done? Will this still be a viable strategy? And the answer is they're not done. You can still use GRATs, you just have to be cognizant that some of your gift tax leverage up front may be gone based on the minimum 10-year term and that minimum remainder value guarantee. So with that greater of 25% or 500,000 amount, you may also need to consider that it may not be worth it to fund a GRAT that's under $200,000, because $500,000 is the break-even point of 25% of $2 million. So this would cut off short-term small GRATs of lower value, would also take away zeroed out GRATs, and reduce the viability of maybe creating a GRAT in your final years of life if it's virtually certain that you won't live 10 more years. Now, long-term GRATs, as I mentioned, could still be a play as well, especially in this rising interest rate environment, because that's virtually guaranteed given how low interest rates are currently. And Code Section 2702 may not provide as much of a benefit for certain long-term GRATs anyway, so you may not be hurt as much with the gift tax valuation on those types of trusts, especially if you create them right now in a lower interest rate environment. So those are the changes to GRATs under the For the 99.5% Act. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.